You've lived all over the world. You lived a long time in Hong Kong. You look at the world markets.
Yes, indeed.
Where would you put money now, in the U.S. or overseas, if you had to choose?
If you're taking a longer-term perspective, we believe that the outperformance in the US that we've seen in terms of economic activity, clearly a divergence earlier this year with the US holding up very well, and we saw that confirmed in the Q2 GDP report last week, whereas we've had a moderation in growth elsewhere. We believe that divergence is likely to close, so we would start to looking outside of the US through the end of the year for opportunities as some of the outperformance from the US is moderated.
Too early to look at emerging markets, or are you talking about mature markets?
We would certainly look at emerging markets. Not sure we'd be moving immediately today. We've heard a report today, just a headline, that US and China are reopening talks again on the trade issues, but we do expect that to continue to be a headwind for emerging markets. But for us, valuations are now attractive, the growth environment is attractive, external balances in emerging markets are significantly improved. We believe the market has overreacted to the trade issues, so we think opportunity.
That sort of leads me to my next and really final question. I'll turn it over to my friends here. But is it likely that the trade situation will mean more to the markets than it will mean to the economy?
We would agree with that certainly it has meant more to the markets. And in our view, if you look at the economic impact, even if you were to see everything that's been announced implement to the full, and if there's no benefit from substitution effects, it may have as much as a 0.6% impact on GDP here in the States, just under 0.5 in China. But we feel that there would be substitution effect. We don't believe everything will be implemented, and there's already been some easing of that. So we think you're looking at about a 0.1, 0.2% impact on GDP in the US and in China, and markets have reacted to a much greater impact in that. So we believe they've included the risk of escalation. So a lot of the bad news, we think, is already in the price.
What about Europe? We saw their GDP numbers come out today, and they look so pale in comparison to the United States, 4.1%. How do you feel about Europe compared to the US?
So our view is that there has been a moderation in Europe, and that is the data that we're now seeing confirmed. But we believe that divergence in growth that we've seen in the first half of the year, that is likely to narrow. So yes, the US has been very strong, and within that 4.1 number, of course, there was an inventory drawdown, so that's a positive to come through. But we think US peaked in the second quarter, will moderate, still above trend as we were hearing, but we see the rest of the world, Europe, Japan, and emerging markets likely to start to improve, and so the gap, we think, starts to close. The US still ahead, but the gap closing, and the markets do like to focus on the second derivative.
Inflation. How hot will it become, do you think, especially here in the United States, where we're so focused on trying to achieve 2% inflation?
Yes.
And maybe even let it go a little hotter than that at some point.
Yeah.
Will it, and will it go much higher than that, do you think?
Yes, so in thinking about the macro environment, the growth for us looks positive. Global growth is above trend. And for us, by definition, that means rising inflation. Inflation, in our view, is rising. It's rising at a very slow pace, but we do see that beginning to pick up later this year and next year. So we do see inflation moving above the Fed's target, as the Fed has already intended, and inflation elsewhere in the world starting to pick up, but still at a very slow pace.